Good morning and welcome. Patriot Radio News Hour. Joe and Jason on this Thursday. Man, April flying by. The 20th of April already. We've got a gold and silver market looking awfully resilient as the sellers continue to just be met with buyers, and it makes a lot of sense because again, I think everything's kind of hanging on by a thread. What card is going to fall that's going to start unraveling this whole thing as well? I'll tell you, you already know, I'm squarely in this camp. We are headed into a major recession / depression. I think we are in the throes right now of stagflation. I think it is really starting to become extremely evident out here. You know, as I said, I don't know how, but we got the second highest gas prices in the country. I mean, we trail only now. Don't count Alaska, don't count Hawaii, but in the 48, the continental 48, I guess we're up to number 2, $5 a gallon. But get ready. It's coming everywhere. And I think this is, going to be the thread, Jason, that we talked about. You know, Jason, we talked about this, gosh, a year and a half ago. Right? We were talking about, hey, it's going to be the double Great Depression, right? Because it's not going to be the depression, right? Was the problem there was deflation or disinflation, that word they, forgot. They brought it up once and now have forgotten it. We actually look at it this way. It's going to be a major, and again, I don't care, recession, depression, call it what you want, okay? But it's going to be with significantly higher prices for a lot of things. Not everything. There's going to be collapses in certain things. But things like food, things like energy, right? These things are not going anywhere. And it's really it's just a matter of when does the Federal Reserve cry uncle. And I think the uncle has gotten a lot closer. 800-951-0592, the website, allamericangold.com. And Jason, we had jobless claims, existing home sales. We had, what else did we have? The leading economic indicators, Philly Fed, and they were all not good. So today was a bundle of bad news, that again, how close is Uncle, right? With more bad news, right? Uncle got closer.
That's right, Joe. That's right. And one thing I'd like to say about what you're in the opening, what you're talking about, is I always like to look at it historically and see what we're mimicking or echoing or what we're mirroring. And we really are in a position where we're mimicking what happened in the 19-teens, 20s, 30s, and 40s. I mean, I think, Joe, in decades to come, they're going to be looking at this time frame that we're living in as being very much like World War I, the Depression, and World War II. Because think of the 2008 crash. In my mind, Joe, that's the 1929 crash in a lot of ways, right? But it didn't really get bad until 1933, and the 1930s got worse, right? I think that's kind of where we're headed right now. And remember, this thing didn't end. There wasn't normalcy until a great economic reset, and that was World War II. That's where we're headed. I mean, you can look at 9/11 as being World War I, right? The war on terror, remember all that? Remember how many economic changes happened around 9/11? That's what World War I set up for World War II. So Joe, we're in the middle of a really catastrophe economically in the world. We're in the middle of it. You talk about the next shoe to drop. I think we're in it. I think we've been in it for a long time, and I think we're in an elevated state. And then it's going to get really severe in the near future. We're in it. We're currently in it. It's hard to say that you're in it when you're in it.
Yeah, you brought up something I think is brilliant. You got to remember, what did the bankers hate about the Great Depression? Right? And again, all banker cost, right? The 29 crash was bad banking and bad oversight of banks, period. Like the Federal Reserve is probably the most inept organization on the history of the planet, and yet we gave them all the power. I mean, it really is. But you brought up something. See, what they hated about gold in the Great Depression is they wanted to go into debt because they thought this would fix it. If we could just increase the money supply, we can fix it. And you brought up the financial crisis. Hey, that was like the 29 crash. I think that's actually really, again, a really great call. Because it was, again, what? Banks behaving badly and lack of oversight from the Federal Reserve, right? The reason they were, quote unquote, created was, to stop these banks from doing dumb stuff. Well, guess what? They didn't have gold that time, did they? And look at what they've done. We had $5 trillion. Let's call it $6, because they had $700 billion on their balance sheet. We had about a $5 trillion debt. It's now 40. And by the way, everyone's barely talking about how bad, right? How bad the deficits are going to be going forward. Everybody agrees it's just a matter of months before the Fed stops quantitative tightening and goes the other way again. Jason, they created this debt bubble. All as they did is, hey, we extended it about 15 years. And guess what? We never fixed the problem, and now all of these problems are coming back because the solution to not fixing the problem simply caused the next problem. Man, brilliant. That's exactly what's happening. Everybody better buckle up. I hope you're taking precautions and getting some gold and silver put away. Patriot Radio News Hour will be back after the break. 800-951-0592, Patriot Radio News Hour. Joe and Jason here on this Thursday. The Dow, the NASDAQ, the S&P, all down again today. It's early, but again, I think Wall Street is sitting in the same spot it's been sitting in for a while now. We had a good start to earnings season with the big banks. Not so good after the banks. Tesla probably the leader in bad numbers. But, again, more and more of these companies now talking about margin pressures here. We've got gold up. Gold's up 7 here, 2002. And gold has been as high as about 2007, 2008 this morning. Silver is right around unchanged right now. $25.25. This market recap brought to you by our friends at YRefi. Listen, you got to be diversified. We all know that, right? I would love it. Wouldn't it be great if you could, hey, I don't have to be involved in the Wall Street casino and all, but you do, right? Because there's no more pensions anymore. You got these 401ks, your IRAs. Everybody out there has to have gold and silver in their portfolio. Everybody does. You got to play the Wall Street game, but you know what? For those of you that got $50,000 or more, you need to check out YRefi because it's not correlated to the stock market. It's not correlated to Wall Street. It doesn't care about earnings. It doesn't care about Jerome Powell and interest rates. You can get up to 10.25% returns. Check them out. InvestYRefi.com. That's the word invest, the letter Y, REFY.com, or just call them 888-YRefi24. And Jason, really quickly, I'm just going to throw this out there. We haven't had silver half dollars in a month, maybe 6 weeks. I've got 3 bags of halves waiting for me. I've gone out and you know what? We're already, as we said, Silver Eagles, we're the cheapest. Silver dimes, silver quarters, we're the cheapest. Silver half dollars, guess what? We're the cheapest. I've got 300 rolls. $300 a roll. If you buy 50 rolls or more, and 50 rolls is a half bag. So if you buy 50 rolls or more, $295, and we aren't like the other guys. We don't sit there and pull out all the nice Kennedys. We don't pull out all the Walkers and charge you more. You're going to get a good mix. You're going to get Kennedys. You're going to get Franklins. You're going to get Walkers. We don't sort it at all. Well, you know what Brittany does? Brittany gets these bags in here, and she counts to 20 and puts them in a roll. That's how we roll here. So silver half dollars, which have been unobtainium, $300 a roll. If you buy 50 rolls or more at $2.95, I mean rolls of quarters are at $2.80. So that's actually it's a really good price, all things considered. Everybody else, because I went and looked, they want $320, $340, $350 a roll. $300 a roll, 50 rolls or more, $2.95 at 800-951-0592. And jobless claims out. This is something now, Jason, after they've quote-unquote fixed it. Because remember, we were going, God, it seemed like forever. We went months where they're like, oh, everything's below 200,000, all-time lows. We haven't seen this since the 60s. And then they went, oh, well, wait. Oh, we had an error, right? We had a spreadsheet error, and they had to readjust everything. Last week, 239. This week, 245, right? And that 250 to 270,000, that's kind of the danger zone, if you will. You get above that, and you've got problems. So it's still below, but getting very close here. 245,000. By the way, that number was the biggest number in like 2 years. And then continuing claims. This is the one that's got me more worried. We don't want to see continuing claims above 2 million. That's bad. They spiked up again this week as well. Now they're at 1.865 million. And to tell you, last week we were at 1.804 million. So a pretty big move here in continuing claims. Again, that's also the highest number in a couple of years here, Jason. And it's early stages here. Early stages of the cracks that are starting to show up in the consumer. We're going to talk about the F word, and I'm not talking about free. Foreclosures. When's the last time we mentioned that word? Foreclosures, car repossessions, and credit card defaults all spiking. And Jason, again, this is another one of these signs, right? It's starting to happen. These cracks are starting to get a little bigger.
Yeah, I saw that some of the companies that had some layoffs, I think late last year, early this year, some of the tech companies announcing another round. So we're getting some companies, I think it was Facebook, Meta was one of them. They're announcing
Facebook, Meta, Disney, yep. Right? I mean, there's a list of that, and it grows every single day.
Well, and having another round means the first round didn't work, right, John? I mean, let's face it, if you want to fix a problem, you fix it. But a lot of these companies, I think with the scare of not getting employment after coronavirus, I think that they're starting to say, well, I guess they're going to stage it slower. Once again, making this crash happen maybe a little slower than we would normally be expecting in a market downturn. I mean, it seems like we've been expecting this recession for 2 years. It's coming. I think it's going to happen this year, but man, has it taken a while to get there. And it's just seems like, to me, Joe, it seems like that the slower this thing takes place, the longer it's going to take to get out of it on the other side.
Yeah.
So I think the inflation and the market chaos that we're going to be seeing, I think getting out of it. I mean, remember how long it took during the Obama years is 0%? How long it took to get out of that, to actually raise the rates again? It just was zero forever.
I just don't know what it would take think about the money they would have to create this time. But let's look at it. First quarter home foreclosures surged, according to the latest data out, following let's face it, a 2-year hiatus. Home foreclosures are now starting to spike again. Home buyers saying that making those mortgage payments starting to become a problem. And now, Jason, some of them, they had recently bought homes and now are struggling to sell them and still be able to get out of them. Now, listen, it's still early here. This is not the foreclosures of the financial crisis, at least not yet. But they're up 22% from a year ago. And by the way, it's 23 consecutive months now where foreclosure activity has increased year over year, Jason, and it's starting to gain momentum. This is kind of the problem, like we said. This has been a real slow process here, and it's starting to pick up speed, and you brought up something really important. All of a sudden now we're getting companies announcing a second wave or a third wave of layoffs. They had been very hesitant, right, because they had been short workers. They didn't want to do it. And I think that's an ominous sign now that I think you're going to see a lot. And again, Challenger Gray and Christmas, layoff announcements up 400% year over year. And I think we're going to see more companies not only do a second or third round, do a first round.
Yeah, that's what the Fed's goal was, isn't it? Isn't that what they said? We need job losses to make this thing right. So they're going to get what they want, Joe. They make the decisions when it comes to interest rate hikes or declines in the amount of money being printed. So it's coming. You know, they're taking their sweet time, I guess, for the serious side effects. But it's coming, and you know, I'll have to state it again. I believe the slower this thing rolls out, the slower the recovery is going to be. I mean, I've seen guys analogies, Joe, where the printing that comes on the back end of this, where there be a year from now, 2 years from now, whenever the printing starts happening, tens of trillions and maybe hundreds of trillions is the next round. Because when the whole thing is completely broken, that's the last card they have, right, Joe? And they really don't want deflation, because that gets all their rich buddies really upset.
Oh. Deflation would be that would make things even worse. Wells Fargo set aside $1.2 billion for loan losses. Bank of America, last year, same quarter, they set aside $30 million. This year, $931 million. So essentially almost $1 billion increase. J.P. Morgan doubled the amount that they've set aside and said that they've charged off $1.1 billion already. So, Jason, it's coming. It's slow, but it's growing, and the pace is picking up speed.
It's picking up speed, Joe, absolutely. Everything we just mentioned just in the last few minutes, it's showing an acceleration of this market weakness, and it's baked into the cake, Joe. This is why they raised the rates and why they continue to raise the rates. They want this result, and they're just trying to make it so it's as painless as possible. But there's so many factors to this, Joe, and we know that the digital currency is an end goal for this new situation that they're putting together. So they're trying to make it, I guess, as painless as possible. But here's the thing, and I think they know this. At some point, especially with the rolling out of digital currency, there's going to be a lot of pain. People have no idea. I mean, we talk and we talk and we talk. We try to get some ideas out there. But the ability for this to be a soft landing overall it's just ridiculous. It's going to be a bad crash landing for a lot of people, Joe.
I'm just going to say it again. The new baseline for the Fed is a mild recession. That's all you need to know. How badly have they missed just in recent time? I mean, go back to Ben Bernanke and Janet Yellen. Oh, it's just a subprime problem. Oh, the markets are a little frothy, right? They raised rates. They were at 5 1/4. It was August of 2007. Ben Bernanke was out telling the whole world, yeah, we're going to raise again at the next meeting. And then all of a sudden, everything started to unwind, and Lehman Brothers went under, Bear Stearns went under, right? We had the Great Recession, as they called it. And then you think about now, right? Inflation's transitory. Right? That was bad enough, right? How about the disinflation speech? Remember? Right? That didn't even, that didn't even make it like 2 weeks before they had to eliminate that word out of their vocabulary. So if they're forecasting a mild one, Jason, I think we're in for a really, really rough ride. And I'm still sitting in the camp. I told you the rate hike this last meeting was a mistake. Jason, they're going to raise again in May. They are determined to do it.
Yes, and I know that a lot of the information is pointing to them stopping, but I still, in my mind, because this is a brand new situation, every situation is different. This isn't going to be the 08 crash. They could raise it a few times, Joe, if they really want to. If they got a certain plan in place, they could do quarter points the year if they want. Not a good idea, but they might do it.
800-951-0592. $50 on sale.